Welcome back to the street on BNN Bloomberg. Investors, of course, have their eyes on China this year as that country's economy begins to reopen. There are expectations of a rapid pickup in domestic consumption, while other sectors appear to remain weaker. For more, we're joined by a featured guest of the morning. He's Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. Good to see you again. Thanks for coming in.
Likewise, Paul. Thanks for having me.
Everybody's looking at China as one of the big investment themes in 2023. You are as well, and you think that there are some significant opportunities here.
Yeah, that's right, Paul. We manage North American equity portfolios at First Avenue Investment Counsel, but the U.S. is a broad and deep market, and so we're fortunate to have, first of all, a lot of global multinationals domiciled in the U.S. that can get overseas exposure, but also some direct foreign listings and American depository receipts. So in the current circumstance where the Western world economies are fairly dramatically slowing down, notably Canada and the United States, where consensus economic forecasts have GDP, or the size of the economy, really decelerating to almost a standstill, about 0.5% growth this year, down from 2% in the States and 3.5% in Canada last year. China stands out. It's out of sync with the rest of the world. It's one of the only large economies globally where things are actually reaccelerating, and that's courtesy of looser monetary policy and also notably the end of the draconian COVID lockdowns that have been start-stop, on and off for 2+ years.
How confident can investors be that the COVID lockdowns are gone?
Well, with COVID, you don't want to bet the farm really on anything because anything can change. But, we think probably this time it is for real. We probably mostly all have, herd immunity or vaccine immunity here in North America. In China, the vaccine that they've been getting hasn't been as widely distributed and it hasn't been as effective. That said, they, in most cases, have acquired immunity the hard way, through contracting COVID and coming out the other side of it.
So you're looking at a range of Chinese indicators. One of them is Chinese air traffic, for instance. What other indicators are you seeing that suggest the economy is on a path to significant reopening?
Well, there's a few, Paul, and I just want to take a step back and tell you why it's important to look at these things. It's due to the simple fact the Chinese economic data, as officially reported by the state, is not always exactly as it seems, and you don't necessarily want to take it at face value. And I will also say that we are very fortunate at First Avenue to have a diverse and talented team, including a colleague of mine who's got boots on the ground, experience running a trading desk in Hong Kong. So, we know what to look for, and certainly air traffic flights are up 50% year over year. That's one very good indicator that mobility is kind of getting back to normal, and the lockdowns don't have the bite or the teeth that they used to. We're also looking at port inventories of coal. That's important because unlike here in Canada and the United States, where electrical power generation is, generally speaking, not done with coal, in China, it's very much a coal-fired economy. So it tells us they're locked and loaded and ready to fire up that industrial production machine again. We also look at purchasing manager surveys, so those don't come from the state, they come from corporates. So these would be the analog to the ISM indices that we talk about here in North America quite frequently. They've gone screaming up way back above 50%, quite dramatically just in the last month or two, so indicating corporates are open for business and ready to expand. And then the other thing that might have a bit of a longer tail to it is we've all read about and heard about a pretty dramatic housing slowdown in China. Some of the data we're looking at indicates that may be starting to level off.
Okay, so what are the tools that investors can use to gain exposure? You've mentioned large corporations domiciled in the U.S. that sell their goods and services to China. There's also Chinese stocks either listed in China or perhaps more appealing to North American investors, Chinese companies listed in New York.
Well, that's just it. So, there's things that you can do thematically. One of the go-to themes for Canadian investors has historically been base metals because China consumes a lot of copper, nickel, et cetera. The other things are the Macau casinos. We don't own those per se. You can try and burn your fingers buying, direct overseas listings. We don't. We like the comfort we get from governance and regulation for ADRs and direct listings on the New York Stock Exchange. So two that we like and have introduced into portfolios recently at First Avenue would be Alibaba, which of course probably needs no introduction even here, even less so in China. It's the e-commerce giant, their version of an Amazon, let's say, and also a leader in cloud computing. So it's got a consumer and a corporate driver to it.
Very much an analog to Amazon. I didn't realize it was a leader in cloud computing. That's also a big part of Amazon's business.
Well, that's right. That's right. So, and it's got some other smaller businesses, local services, and there's an international e-commerce business. But generally speaking, it's a very good pure play on the Chinese economy, both consumer and corporate, and we think they're both reaccelerating. And then the other one would be Yum China Holdings, Inc. And North American investors are probably familiar with Yum Brands, which was formerly the parent company of this entity. It's listed on the New York Stock Exchange, but Yum China Holdings is the master franchisor for Kentucky Fried Chicken, or KFC as they now call it, and Pizza Hut in China. It's growing very, very quickly. It's been there a long time. It's got tremendous brand equity there and still a lot of white space, such that they're opening 1,100 to 1,300 stores next year alone on top of the 12,000 and some odd they already have. And we expect they will see good operating leverage because they own and operate most of their restaurants, and also good same-store sales growth courtesy of pickup in traffic and pretty good menu innovation as well.
That's Brian.